Welcome back to the channel, everyone. Before we dive in, smash that subscribe button and turn on notifications, because what you're about to hear could completely change the way you enter trades. I'm not talking about some theory or a tip you've seen 100 times online. I'm talking about a real-world strategy to fix one of the most common mistakes almost every trader makes: the timing of your entries. So hit subscribe, settle in, and let's go. Let me ask you something. How many times have you entered a trade, thought it was perfect, and then watched it immediately reverse? How many times did you think, "I'm early, I'll catch the trend," only to end up frustrated, wondering what you missed? You're not alone. The truth is, most traders don't just misread the market, they misread themselves. And entry timing is where that misreading is the most costly. Here's the brutal reality. The market doesn't care about your plan, your hope, or your feeling of urgency. Every time you enter a trade based on a gut feeling or impatience, you're feeding the market. You're playing the game backwards. And the first step to fixing this is understanding a concept most traders never learn: the difference between entering early and entering smart. Think about it. If you enter too early, you're risking the worst-case scenario: a pullback or a fake out. You're not trading the market, you're trading your expectation of what you hope will happen. And hope doesn't pay. Pro traders don't hope. They wait. They wait for clarity. They wait for confirmation. They wait for the market to tell them, "Yes, now is the time." Let's break this down with a simple analogy. Imagine you're trying to jump onto a moving train. If you try to jump too early, you'll fall short. If you jump too late, you'll miss it entirely. The only way to land safely is to observe the train, predict its speed, and then jump at the exact right moment. That's entry timing. Most traders either jump too soon because they panic or too late because they hesitate. Pro traders? They calculate and wait for the exact timing window. Now, I know what you're thinking, but I want to catch the trend early. That's where the big gains are. And I get it, that's the human instinct. But here's the counterintuitive truth. Catching a trade too early often reduces your probability of success. The bigger trend is not going anywhere. Entering smart is not about being first. It's about being right and reducing risk. Let's talk about a real-world scenario that hits every trader. You see a breakout candle blasting above resistance. Your brain screams, "Get in now!" Heart rate spikes, palms sweat, dopamine surges, and you click buy. Within minutes, the candle reverses, stops you out, and your confidence takes a hit. This isn't bad luck. This is classic mistimed entry. You entered before the market confirmed commitment. So how do pro traders avoid this trap? They use what I call the second signal principle. They don't enter on the first explosive move. They wait for the market to give a second signal, a retest, a confirmation candle, or a pullback that proves the initial move was genuine. That second signal drastically increases probability because it filters out impulsive moves and false breakouts. Let me give you a mental model for this. Picture 3 stages. Stage 1. The first move: explosive, noisy, emotional. Most retail traders jump here and get trapped. Stage 2. The confirmation: price retests, volume sustains, structure forms. This is where pro traders step in. Stage 3. The continuation: the real trend follows. This is where profits compound. Notice the pattern? The pros ignore stage 1. They don't chase. They observe. They wait. And they enter at stage 2 where probability is in their favor. Here's the catch: waiting requires mental discipline. It goes against every instinct you have. Human brains are wired to react to movement. That's why the first big candle looks irresistible. Your emotions want to react. But professional traders have trained themselves to detach from that emotional trigger. They see movement but remain neutral. They see opportunity but don't act until clarity arrives. This isn't hypothetical. This is how consistently profitable traders operate. They're not faster than you. They're not smarter. They're disciplined. They let the market tell them when the high probability entry has arrived. And they never enter based on excitement or fear. Another huge mistake traders make is ignoring context. The first candle looks amazing on its own, but without context, the trend, support/resistance, liquidity zones, and market behavior. It's meaningless. Pro traders assess the environment first, then the trigger, then the execution. Without all three aligned, they stay out. That's how they protect capital and maintain consistency. And here's the kicker: once you internalize this, your mindset changes. You stop chasing trades. You stop fearing missed opportunities. You start entering only when the market validates your setup, which feels completely different from impulsive trading. It's calmer, controlled, and much more profitable. Alright, let's dig into the actual mechanics of timing your entry properly, the part most traders completely get wrong. And here's the truth. It's not about predicting the move perfectly. It's about waiting for the market to reveal its intention clearly. The first explosive candle, the first breakout, the first big green or red spike, that's emotional noise. That's not a signal. And yet, most traders treat it like gospel. So how do you know when the market is really ready for you to enter? That's where the second signal comes in. It's subtle, but once you understand it, it completely flips your approach. The second signal is the market confirming commitment. This price behavior proving that the initial move wasn't a trap. And here's what to look for. 1. Retest confirmation. After the first breakout, the market often comes back to retest the level it just broke. Watch how price behaves during this retest. Does it bounce with strength? Does volume support the move? If yes, that's your green light. If no, the move is likely fake. 2. Candle validation. Look at the next 1 or 2 candles after the pullback. Are they forming higher lows or lower highs consistent with the breakout direction? Are the bodies solid, or are they weak and indecisive? Strong, decisive candles after the retest signal real commitment. That's the entry point pros wait for. 3. Volume confirmation ***. This cannot be ignored. The first explosive candle might have huge volume, but pro traders look for sustained volume. Consistent participation shows that real money is behind the move, not just retail traders getting trapped. 4. Behavioral cues, and this is subtle but critical. Watch how trapped traders react. Are people panicking out of positions, adding fuel to the momentum? Are the impulsive traders getting squeezed? Pro traders use this behavior as a guide. They enter when they see the market behaving predictably in its own favor, not based on excitement. Here's an example to make it crystal clear. Imagine a resistance level you've been watching for days. Suddenly, a giant green candle pierces through. Retail traders scream, "It's breaking out." They jump in immediately, but then price pulls back, tests the breakout level, and holds steady with a confirming green candle and strong volume. That's your second signal, the perfect entry. The traders who jumped initially are likely trapped. The pros wait, observe, and step in after the confirmation, drastically improving their probability of success. Now, let's talk about the psychological side, because timing isn't just about charts, it's about the brain. Entering too early is a dopamine-driven mistake. That first explosive candle triggers FOMO, excitement, and fear of missing out. Your heart races, adrenaline spikes, and your fingers move to hit, buy, or sell before you've fully processed what's happening. That's the exact moment the market is designed to test you. Pro traders know this. They've trained their brains to detach emotion from the charts. They see the first move, but their mental state doesn't change. They stay calm, neutral, and fully focused on observing the market. Discipline beats excitement every single time. Here's another real-world insight. Most entry mistakes happen because traders ignore context. They see a breakout or pullback in isolation. They don't consider overall trend, liquidity zones, support and resistance, or larger market behavior. The first move looks amazing, but without context, it's meaningless. Professionals assess the environment first. Then they assess the trigger. Then, and only then, they act. This also changes your perception of missed trades. When you understand that the first move is often a trap and that the second signal is where probability favors you, missing the first candle no longer feels like failure. In fact, it feels like a gift, because the market is giving you a safer, higher probability entry, and patience rewards more than impulsiveness ever will. Let's break down how to train yourself to catch these second signals consistently. First, define your criteria. What constitutes a valid retest? A strong confirmation candle and acceptable volume. Write it down. Make it specific. Make it non-negotiable. This is your mental checklist, your safeguard against emotional entry. Second, practice observation without trading. Watch charts without touching your keyboard. Note every first explosive candle, every retest, every confirmation. Log the outcomes. This builds a mental library of market behavior. Over time, your brain starts to recognize patterns automatically. You begin to intuitively spot second signals before entering, without the emotional rush. Third, automate your patience triggers. Create simple rules. Do not enter until X, Y, Z criteria are met. Make your brain follow the rules, not feelings. Discipline becomes habit, and once habits replace impulsive reactions, your entries naturally align with the highest probability moments. Now here's the kicker. This approach isn't slow. It's efficient. Many traders think waiting for confirmation means missing opportunities. That's a myth. Waiting actually ensures you enter at a higher probability, reduce risk, and maximize reward. Think of it like waiting for the tide to rise instead of jumping into the water as soon as you see a wave. The wave alone is unreliable. The tide confirms the environment. And don't forget risk management. The second signal approach actually makes your stops more precise. When you enter after confirmation, you have clear levels to place your stop loss, often just below the retest zone or confirmation candle. You reduce guesswork and emotional stress because the market has already proven itself. By following this method consistently, you'll notice something almost magical. Your winning trades increase, your emotional stress decreases, and the market stops feeling like a chaotic roller coaster. You start trading with clarity instead of chaos. You start entering with logic instead of hope. And that, more than anything, is what separates consistently profitable traders from the rest. Now, let's take this to the next level, the mental framework and execution strategy that ensures you never enter a trade too early again. Because understanding the second signal is one thing, but applying it consistently is where most traders fail. And the key difference between consistently profitable traders and everyone else isn't knowledge. It's mindset, discipline, and structured observation. First, let's talk about mental preparation. Before the market opens, pro traders define what counts as a valid setup. They know exactly what the second signal looks like, what levels must hold, what volume confirms, and what candlestick patterns signal commitment. They create a checklist that removes ambiguity and emotion. When the first explosive move happens, they don't even think, their checklist does the filtering. This is huge because the human brain reacts to movement with instinct. The first big candle triggers FOMO, excitement, and fear of missing out. If you rely on your instincts, you'll enter impulsively almost every time. Professionals counter this by turning observation into a habit, and habits are stronger than impulses. They've trained themselves to stay calm, patient, and neutral in the face of market noise. Next, let's discuss execution discipline. Entering a trade at the right moment requires precise alignment of multiple factors. Trend context, support and resistance, confirmation candle, retest behavior, and volume. Missing even one factor reduces probability. That's why pros wait for the full alignment. Waiting isn't hesitation, it's strategy. Entering with all factors aligned is high-probability execution. Here's a mental trick to help you internalize this. Imagine your entry as a locked door. The first signal rattles the handle, tempting you to open it prematurely. The second signal actually unlocks the door. Only when the door is unlocked do you step inside. Everything else is guessing, gambling, and unnecessary risk. Another critical aspect is reading trap traders. Most traders enter on the first move and panic during the retest. Professionals watch how these traders react. Are they squeezing themselves out? Are they holding positions weakly? This behavior creates predictable opportunities. By entering after the confirmation, you're often stepping in right as the market stabilizes, avoiding the chaos and stress of being caught on the wrong side. Now, let's break down real-world applications. Imagine a volatile breakout scenario. Retail traders jump in immediately. Then price pulls back, tests the breakout level, and holds steady. Volume remains strong. The candlesticks confirm strength. This is your second signal. Entering here ensures reduced risk because your stop loss can be tight and logical. Higher probability of continuation because the market has already shown commitment. Less emotional stress because you're not fighting impulsive thoughts or FOMO. The beauty of this method is that it works in any market condition, trending, range-bound, or volatile. The principle remains the same: wait for confirmation, enter with clarity, and manage risk logically. The first move is just noise. The second signal is truth. Let's also talk about building consistency. Observation is not enough if it's passive. You need to actively track every first move and every second signal, note the outcomes, and learn from patterns. Keep a journal. Record entries, exits, confirmations, and failures. Over time, your brain develops pattern recognition automatically. You begin to sense high-probability entries intuitively without being ruled by emotion. This approach also shifts your perception of missed trades. When the first move spikes without confirmation, you're no longer frustrated. You understand that missing the impulsive entry is actually an advantage. You're now waiting for the high-probability setup. Missed opportunity turns into patience, and patience compounds profits. And here's a psychological hack professionals use. Disconnect your ego from the trade. Most traders want to enter early to prove something. I was first, I was smart, I caught it. Professionals don't care who's first. They care who's right. They care about probability. They care about capital preservation. Ego-driven early entries are emotionally reactive, low-probability mistakes. Rule-driven second signal entries are disciplined, high-probability wins. Let's summarize the steps for applying this in real time. 1. Predefine your criteria: what counts as a valid retest, confirmation candle, and volume. 2. Observe, don't react. Watch the first explosive move, but don't touch your keyboard. 3. Confirm alignment, ensure trend, support/resistance, candle structure, and volume all agree. 4. Enter after second signal, step in when the market validates itself. 5. Place logical stop loss, just below retest or confirmation candle to protect capital. 6. Manage trades, follow your plan, don't chase, and let probability work in your favor. By following these steps, your entries shift from impulsive to strategic. Your trading becomes calmer, your results more consistent, and your emotional stress dramatically lower. You'll start to notice patterns, anticipate moves, and avoid traps that ruin most retail traders' accounts. Finally, here's the ultimate takeaway. The first move is noise. The second signal is opportunity. Stop trying to catch the first candle. Stop letting your emotions dictate entries. Wait for confirmation. Enter with clarity. Protect your capital. Trade with probability. That single mindset shift will change everything. If this video gave you real value, take a second to hit like, drop a comment sharing your biggest takeaway, and subscribe to the channel so you never miss these high-probability trading insights. And while you're at it, check out the other videos on the channel. They're packed with strategies and mental frameworks to elevate your trading game to a professional level. Thanks for listening, and I'll see you in the next one.